Is the economy in good shape despite our national debt? And is the housing market doing okay? Today we sit down with economist Mark Skousen to find out what's going on.
Consumer spending is still growing quite rapidly, and that's where a lot of inflation is as well. But the business sector of the economy is kind of slowing down and possibly even in recessions. You need at least a 10% return on your investment, I think, to keep up with all the rising cost of living.
Mark, it's great to have you on. Welcome.
Well, thank you. It's good to be here.
We want to talk to you about the economy and markets.
Yeah.
How are we doing with the economy?
Well, I think there's a disconnect between Wall Street and the economy. There's certain sectors of the economy that are doing very well. And of course, technology, AI is the hot topic. And in fact, there's some evidence that may be overheating, that there's too much positive things going on in the technological and the data centers and the chip making and all of this kind of thing that's going on. That's a booming part of the economy. Banking sector, real estate, industry in general is slowing down. I have an index called the B2B Business Index, business activity. It's growing, but very slowly, much slower than GDP itself. The only thing that's really booming in that regard is consumer spending. Consumer spending is still growing quite rapidly. People are buying cars and appliances and entertainment and all of that, food and that sort of thing, and that's where a lot of inflation is as well. But the business sector of the economy is kind of slowing down and possibly even in recession. So it's something that is worth watching and be concerned about.
What's the impact of that? So you see there's certain sectors that are doing well, and like AI and technology, but then other sectors are kind of not doing well. What's the impact of that?
I think a lot of it has to do with the fact that we went through this huge inflationary boom after COVID, after 2020, and the Biden administration pumping money into the system, running huge deficits, and expanding the money supply and easy money and all that sort of thing. And we've had to now control that, try to get control of it, because the boom, what happens after a boom? You have a bust of some sort. And so we're probably going through that bust phase that Trump is having to deal with. And it is something to be concerned about for sure. Stock market's done really well this year, but there is concern as we move into 2026 that we may face a recession. And one of the problems is the trade war. The tariffs have increased the cost of a lot of goods and services that we import, as well as the components that go into it. I mean, when you impose a 50% tariff on steel and aluminum, well, that's used in all kinds of products, in automobiles and appliances and stuff like that. The other thing that I'm concerned about is job creation. The job market has been really slowing down. I teach at Chapman University, and my seniors are really worried about the job market. AI has disrupted the job market. There's a lot of concern that maybe that job that used to be there is not going to be there anymore because of AI. There's some real concern about where the economy is headed as we approach this next year.
So you mentioned the technology sector, AI is overheating. What are your thoughts on that? Do you think it's a bubble?
Any new technology, I mean, if you look at the dot-com boom in the 1990s, it got carried away, and it was a bubble, and the bubble burst, and it took 3 years to recover. And yet there was still technology there of the internet that was viable. It wasn't just all fake. The same thing's happening with AI. Although the demand for AI is growing faster than they can provide the supply of it. And they're trying to build these data centers very quickly, the chip making and all that sort of thing, and they can't keep up with the supply. I mean, NVIDIA just had another breakout outlook. Their business is booming, and they can't keep up with it. There's some justification for the high valuations for NVIDIA and all the other different companies, Microsoft and Apple and everybody else that's involved with the AI phenomenon, even Tesla and so forth. Everybody is affected by this. So they can't keep up with the demand. The valuations are justified to some extent for being higher. But there is worry that we're creating a bubble, that it's artificially going too far, too fast. And that's why the stock market, I think, is in a bit of a correction right now. But there's still a lot of legitimacy in the AI. We're just getting started, really, in this. So,
what are your thoughts on the national debt right now, and how is that impacting the economy?
we had a debate yesterday with Steve Forbes, and I were on the side of, hey, this is a growing crisis that we need to address. And then you had John Tamney, who's with Real Markets. He said it's not a problem, and we've always worried about the deficit, and the national debt keeps growing, and yet the crisis is postponed. Armageddon is postponed. But the fact of the matter is that the interest on the national debt now is the biggest budget item, and it's bigger than the defense spending or military spending, the Department of War, as it is now called. I think that's a legitimate concern, that we are entering a late phase where bankruptcy, how does bankruptcy occur? Gradually and then suddenly. What we're concerned about is we're building this national debt problem of excessive government spending. When you have a balanced budget, no balanced budget amendment, what's to keep the government from keeping and spending more and more and more? Taxation is very unpopular, so you don't raise taxes, but spending is very popular. Spending grows faster than taxation, creating these huge deficits. And we were at full employment. Even the Keynesian model is if at full employment, you should be running surpluses. And yet our deficit is still $1 trillion, maybe $2 trillion. So it is a danger sign for sure, and it may mean higher interest rates, crowding out of private investment. The one thing we know is that the national debt as a percent of GDP, of the economy, if it exceeds 80%, and we're at 120% right now, anytime you go over 80%, all the studies, most of the studies show that the economy slows down because you're spending too much on government, unproductive government, wasteful welfare and wars and stuff like that, when you could be spending that money on productive enterprises and AI and all of that sort of thing. So the end result is slower economic growth as a result of this monstrous debt that's getting bigger and bigger. So that is my biggest concern, and it could easily get out of hand where the Treasury will have to raise interest rates dramatically just to get people to buy the government debt.
Do you think we will get to that point where the interest rates will go up significantly?
We've avoided the crisis for decades. There have been people all along. I remember Harry Figge wrote a book called Bankruptcy 1995. That was when the debt was $5 trillion. So we've cried wolf for many years, and yet that doesn't mean the wolf isn't going to start knocking at the door at some point. And that's why I use this line, which is from The Sun Also Rises, Ernest Hemingway's, about this man who said, well, how did you become bankrupt? And he said, gradually and then suddenly. I think we're in the gradual phase. We've had an incredible ability to increase our debt and people willing to buy it. Why? Because it's AAA rated, right? So it's safe investing. But there are competitive assets. You can invest in corporate bonds. You can invest in the stock market, interest-bearing stocks. You can invest in gold. You can invest in Bitcoin. Investors have these alternatives. What if you get to the point where saying, it's just not worth buying the treasuries because inflation is so bad, they're going to have to pay me a very high interest rate for me to invest in treasuries. That's where you have the crack up boom, where you have this sharp rise in interest rates because the treasury has to sell. I mean, right now, the U.S. government has to refinance $7 trillion this year. By the end of this year, $7 trillion in new debt financing. So you got to get institutions and investors willing to buy $7 trillion worth of treasuries. And you're only getting 5%, 4%? That's not a lot return. I mean, inflation could get worse than that.
When you mention inflation could get worse than that, what do you see happening potentially? Where would the long-term interest rates would be headed?
Well, we've entered an era of permanent inflation. I showed a chart yesterday in our conference here of that since World War II, inflation has become permanent, rising every year. Prior to World War II, that wasn't the case. Inflation would flare up during a wartime and then come back down. Flare up in the wartime, come back down. But after World War II, the inflation just kept going up and up and up. So the chart looks like this in our history. And then suddenly World War II, it goes up and up and up.
So the prices would constantly go up.
Every year inflation gets, or prices rise. Now the rate of inflation will vary. It would be up a little bit or down a little bit, but it's always positive.
The price is always going up.
They're always going up. So we've entered an era of permanent inflation, and everybody has to protect themselves in terms of getting wage increases, return on your investment. You need at least a 10% return on your investment, I think, to keep up with all the rising cost of living. We see housing prices going up, food prices going up, and a lot of it, trade war and the tariffs have not helped because that has increased the cost of these components. It's increased final good prices. So that's been a problem. These politicians saying, we're gonna end inflation. Well, that's cocky-pog. Inflation is here to stay, and we need to keep that in mind.
And do you see commodities get a lot more pricier from here? Gold and other types of commodities. There are certain commodities that show like more their precious metals for value preservation, and then there's other commodities like oil and other resources that people use for the
silver and copper and aluminum. They're all rising in price. Uranium is rising in price because of nuclear growth and nuclear power. Gold has been on a huge bull market. I mean, 2 or 3 years ago, it was at $2,000 an ounce. Now it's at $4,000 an ounce. It's doubled in price. And that's normally the best indicator of inflation and deterioration in the value of the dollar. Dollar has been weak under the Trump administration, mainly due to these tariffs. Gold has done really well. I'm not sure it's the best investment right now at $4,000 an ounce. It seems like it's gone up too far, too fast. Silver's over $50 an ounce. Copper is over $5 a pound. Uranium is close to $80 a pound. Yes, commodity prices are rising, and that's the basic price floor, if you will, for raw commodities, the basis of our industrial economy. So that's causing prices to go up as well. By the way, let me mention, the one thing that is going down is Bitcoin. Bitcoin is now under $90,000 per coin, and it was as high as 120, 130. So that is one of the few commodities, if you want to call it a commodity, that has declined in price.
If you look at the economy right now, what are the areas that are potential opportunities besides the technology and AI that's booming? Is there any other sectors that you see there's opportunity for people to invest in?
It's tough to say. I do think uranium and nuclear power as an alternative energy. I mean, some people think solar and stuff like that also has a unique opportunity, more than wind and stuff. That's, I think, a disaster and should be discontinued. But even solar has environmental problems, destroying the landscape and that sort of thing. But nuclear power has this new boost from the Trump administration, the executive orders by President Trump. It's the best alternative energy source that we can get. And you have these small nuclear power plants now that can be built in 3 to 5 years instead of taking 15 years with these giant nuclear power plants. So it's good to see something like that. We're probably going to start catching up with the Chinese, because the Chinese, of course, lead the world in nuclear power plants and coal as well. So they have major pollution with the coal, but also they have the nuclear power plants, which has, it's the cleanest of all those. Natural gas, too, is another area. Natural gas is going up in price quite a bit and is a booming area, I think more than oil. So natural gas, uranium, I think is a really, those are two areas that I'd like to see growth. And of course, AI and everything there with the data centers and stuff like that. The whole energy field has been reinvigorated with these data centers. They have to be, energy has to be provided for these data centers. So that's keeping the oil price high, around $60 a barrel, because Trump would like to see it down to $40, but it's not happening because there's so much demand for these data centers and AI.
And Mark, you mentioned the stock market is not representing the true economy, what's happening in the economy. It seems like some people have a lot of wealth and others are not doing as well. When it comes to the housing market, the affordability is not that high for a lot of people. What are your thoughts on the housing market?
Well, I think this is where regulation has hurt the market. And so many environmental regulations have retarded new housing, even apartment buildings and that sort of thing. The supply being held back while inflationary demand continues to rise has caused a spike in housing prices. And as a result, mortgages as well have declined. The Economist had a major article on the dying mortgage market because people aren't moving. You don't want to sell your house to buy another house that's much more expensive, and your real estate taxes go up, especially in California. It's causing people to stay where they're at and not buying new homes and so forth. And meanwhile, apartments and that sort of thing, as an increasing population, it's putting a squeeze on housing. So this is an area where government needs to back off all their regulations and allow housing to be developed. It's a real problem.
Do you think housing prices gonna stable at this place, or do you think they're gonna come lower?
I see higher housing prices. I don't think supply is keeping up with demand.
What about incomes? Where are the incomes headed? You said you're worried about jobs.
Yeah.
Are the incomes gonna rise, or is that gonna be an issue because people may not get paid as much because they're getting replaced by technology?
Yeah, I think that's a real concern. Biden administration income did not do particularly well because of the inflation problem. I think they're doing a little bit better now if you do have a job. That's the key. And of course, job creation is a real problem. My latest article in the Wall Street Journal emphasized, I created a bit of a firestorm with my article on inequality and what's happening in the private sector. So it was called, We Need to Share the Wealth Rather Than Redistribute It. And the idea is the government's policy to reduce inequality is to impose a minimum wage, a living wage. It's to engage in progressive taxation, to tax the rich and give to the poor, this kind of thing, all very artificial. But what I pointed out in my article is that the private sector is actually reducing inequality on their own without the use of government, and government policies are unnecessary. And what am I talking about? Profit-sharing plans. More and more companies, large and small, are offering profit-sharing plans. They're helping to contribute to 401k plans. If you invest 5% in a 401k plan, they may add to it, give up to half to become a partner with you, the profit sharing. They have stock grants, they have stock options that you can buy. And I pointed out that companies like AutoZone and Microsoft and Tesla and all of these different companies, Home Depot, have made ordinary citizens, not just the CEOs and the executives. Yes, they become multimillionaires because of stock options and so forth. But ordinary citizens, I estimated 30,000 Microsoft ordinary workers who work for Microsoft, secretaries, janitors, staff members, because they got stock options just like Bill Gates did in Microsoft. They become millionaires or multimillionaires, 30,000 of them today. Home Depot, people who were pushing carts around at Home Depot have become millionaires. I mean, it's been highly beneficial for companies that have had good stock performance and have done well. Now, there are companies that haven't done particularly well, okay, like Walmart or something like that, where their stock options haven't been that great. But companies that have done well, NVIDIA, for example, the shocking thing about NVIDIA is that 85%, something like 85% of employees are multimillionaires. Some of them were $25 million or more because of profit sharing and stock option programs. So these are normal staff members that are becoming wealthy. And it's a great way for the private sector to solve the inequality problem.
Now, in terms of the future in the next couple of years, do you see the economy having a soft landing?
We're in a slowdown economy, not a recession yet, but it could enter into a recession, especially if the tariffs really kick in and have a big negative impact on costs, so the consumer stops spending, business has a hard time getting new products on the market. There is that threat. But it's not a foregone conclusion. I mean, it's possible that we could avoid it. I mean, we're in another roaring 20s. And technology back in the 1920s was a big factor with the automobiles, radio, appliances, all of these different things that were happening in the 1920s. Caused a roaring bull market and a roaring economy up until 1929, of course. Then everything changed. We're in a roaring 20s kind of situation again, and so we may escape the recession that is always threatening. Like I said, B2B spending is declining or has shown weakness recently, mainly because of the tariffs and that sort of thing. And who knows? War could break out. There could be difficulties in that regard. There's always some uncertainties. Could have another pandemic. I mean, it's really hard to predict these kinds of things. But overall, I'm optimistic that the slowdown economy will recover and we'll do okay, and the stock market will continue to do well.
You mentioned the consumer is still strong, and despite that there's been a slowdown time. Do you know why?
It's a good question because normally business spending and consumer spending go together. Consumer spending's rising, so that encourages business to spend, or business is spending and doing really well, and that's creating good jobs. And if you have job security, that's when consumer spending tends to go up. It's business oriented. The economy is all dependent on the business sector. And the business sector is in some disruptive stage right now, creative disruption, if you will. Consumers are spending probably because they got so much money, free money from the Biden administration, they still are spending that money. Either business spending picks up with consumer spending, or consumer spending now starts pulling back. And right now, I think there is a little bit of concern that consumers will start pulling back as business has been pulling back, and you'll enter a recession. But if it's probably a mild recession in that regard. So it's not something I'm particularly worried about.
And from what we've seen recently is that they've been lowering the interest rates, but the long-term interest rates are not moving.
Not coming down.
not coming down. What are your thoughts on the interest rates?
Well, certainly Trump is trying to pressure the Fed to lower interest rates, but the Fed can only control the short-term interest rates. And even then, you can't have too much of a disparity, because if you have extremely low interest rates, then banks will borrow from the Fed and turn around and loan the money out at much higher rates, and that will create an inflationary boom that's not sustainable, and you get a business cycle and you know, the boom followed by the bust. I think the Fed is doing a reasonable job under Jay Powell. He's not the ogre that President Trump seems to think. In my portfolio, in my newsletter, Forecasts and Strategies, I don't have any Treasury bond position at all. I mean, 30 years at 3 or 4%, 5%, that's not enough to keep up with inflation. I think you need a 10% return, which you can get with the stock market. The mining stocks have been our best performer this year. We're up over 100% in mining stocks and that sort of thing. So there's definitely better alternatives to keep ahead and maintain that 10% gain that you need in wages and investments.
In terms of deregulation, there has been a lot of effort to do deregulation with this administration. How do you think that will impact the economy?
Well, we've had tax cuts, which I think is beneficial, because that always means more money in the private sector. So that's beneficial. And Trump was famous in his first term to deregulate the economy, and he said, for every new regulation, you need to get rid of 2 bad regulations. DOGE was an effort by Elon Musk and others to sharply reduce regulation. I don't know how successful it was in that regard, because there's state regulations too, you know, and local regulations, construction and that sort of thing. It's not all just on the federal level. But I think the Trump administration is overall doing a good job in that regard, except when it comes to tariffs. I think that's a tax, and that's a mistake. And he's already having to back off of that, which I think is a good indication that the president is more flexible than we realized. Well, we've had a really good run this year. You know, the presidential cycle, usually the first and second year are the toughest. Despite all the craziness that has gone on in the last year with the president, you're not sure what he's going to do here and that, the market has done extremely well. And, you know, the stock market's always forward-looking. And so so far, it suggests that things are moving in the right direction overall. We will see what happens with this correction in the stock market, how long that lasts. If it lasts for a long period of time, that's not a good sign. But if we see a turnaround, then the Wall Street is basically saying the overall things are looking up.
Mark Skousen, economist, it was great to have you on. Thank you.
Yeah, my pleasure. Thank you.